Thank you for listening to this episode, and follow the podcast on social media by finding @Prestigious_Pod. And if you'd like to be coached on how to live a more prestigious life, you can reach out to me, Chris Bean, @ChrisBeanOfficial, or by emailing the podcast directly at prestigiousInitiative@gmail.com. Lastly, sign up for our newsletter either through social media or on our website. This is the Prestigious Initiative. Welcome. I'm Chris Bean. Today I'm privileged to speaking with Steve Selengut, a seasoned investment manager with over 40 years of experience. Steve is the author of Retirement Money Secrets and is known for his expertise in guiding individuals towards income independence. Our conversation today, we're going to be diving into the principles of income, focusing on investment, discussing some common pitfalls in retirement planning, and uncovering strategies to generate consistent income regardless of what market conditions are. So, Steve, welcome to the show.
Oh, thank you, Chris. Happy to be with you.
So, Steve, why would somebody want to listen to our conversation here today?
Well, I guess if they take a look, most people have some form of investment program in effect. And when they look at it, most often they're looking at what the market value is. But if they took a moment to look at the level of income that the portfolio is producing and what that amount of income could be doing for them, either helping them say, okay, I don't like this job anymore. I want to find a new one. I need to be able to fund that space when I don't have a job, or if they're looking to start a business of their own, or if they're looking to retire. That income number is a number that becomes very, very important. Most people would look at a portfolio of theirs today and they'd realize, probably kind of like that, holy mackerel, this thing isn't even yielding 3%. What can I do with that? And I'm paying this guy 1.5 to manage it for me. So there's nothing left for me. That's what most people will see if they looked at their portfolio today. In my style of investing, when you look at that portfolio, you're going to see it generating 10% or close to it. And that's without counting the capital gains that you can take during the year in managing your portfolio if you choose to do it yourself.
Well, okay. So, then
that's what we're going to talk about.
Yeah, well, let's dive right in. So can you share a little bit about your background and what led you to focus on income-focused retirement investing?
Okay. Goes back a long way, as you can manage when you realize how old I am. But back in the 70s, when I got started investing, I came from a fairly wealthy family. A business guy, a guy owned his own business. My dad, he had what's called an integrated business where he pretty much controlled all aspects from the lumberyard that would handle all the materials he needed to build homes with, to an insurance company that would sell the insurance to the people who bought homes from him, rental income. He even went so far as to play banker and fund their mortgages. In those days, you could buy a summer home at Lake Apacon for $25,000. So, we're not talking big numbers, but in those days they were pretty big numbers. Okay, so I got used to the idea, and he pounded it into my brother and I that it's income that floats the boat, that keeps you going, that pays the bills, that pays for the nice dinners, the big birthday parties, and your college education. Okay, so he ingrained it in us. So when I started investing, I had nothing but dividend stocks. Everything always paid money, and I looked at this broker I had, and I looked at the charts and things, and realized that a company like Exxon, Esso, Shell, I don't know if it was Walmart then, but Sears at that time, they just went up and down in price all the time, depending on what was going on in the economy and the world and so forth. And we set a number as what our profit target was for every security. We found about 200 stocks that paid dividends, and we bought them when they were down from their 20% from their 52-week high. We had 10% profit. We sold them, and we just did it over, over again. Exciting and boring at the same time. But we could depend on the company staying around. We weren't taking any great risks. And within 5 years, I was making four or five, well, within 9 years, I was making 4 or 5 times my employment salary in New York. So I decided I didn't want to be a commuter anymore. I didn't want to wear any three-piece suits anymore. And I said, see you guys. And I started a investment management business focused on income. And I could show prospects. I could show actually a couple friends of mine are my first prospects. I could show them the amount of income I was generating on my portfolio. And I could say, look at their portfolio and show them what they were generating on their portfolios. This is the difference. This is the difference. I can do that for you. And they said, okay. So, 40 plus years later, I sold that business for what they call an offer you can't refuse, like the equivalent of 6 years income in advance, 110 million under management at the time. And now I'm just talking about it and coaching people on how to get to the point where their income can allow them to leave their current business like I did. Their income can fund their development of a whole new business like mine did. And then finally, when they're selling that business, and in finance, they don't pay your money all at once. They spread it out over 2 years. So your portfolio is generating enough income to keep you at that lifestyle you become accustomed to for that year or more that you're waiting for the rest of your money. So that's how I got to where I am today. I'm a teacher.
So wildly interesting. A couple different ways I want to approach this. With that as the background, and you have so much time doing that type of investment portfolio and working with your clients to do those things, how does the market look nowadays compared to it was then? Can somebody still apply those same type of tactics that you used then now in like today's market?
It's even easier to. Because so much information is at hand, and it's so easy to place orders. In the old days, it was like a 3-step process. You'd figure out what you wanted to do. You'd tell your broker what the order was you wanted to place, was to buy or sell. He had to write out a ticket. He'd take it across the office to what they called a wire operator. And then the wire operator would, on the wire, send that to wherever it went before it got to the floor of the exchange and actually became an order. So today, you're looking at your Fidelity account and you see you've got a 4 or 5% profit there, and something you go to the side, you push tab, it says buy or sell, you hit sell, you put in the price you want, and bam, it's done. So it's a whole lot easier to spend the time and everything and the tools you have. Fidelity statements today give me all the information I need to manage my portfolio. I can put columns in different orders so I can see what my diversification looks like. I can see the yields of the various securities I own, their prices, where they are. Do I want to buy more of this? Has it gone down so I can buy more? I see price movements differently from most people. I see lower prices as an opportunity, not as a problem. If you know the quality of what you own, and you know that you have a nice diverse portfolio, and you have literally hundreds of securities to choose from, when the price of one of my funds goes down, I look at it as an opportunity to add to it if I already own it at a lower price, increasing my yield, reducing my cost overall. so that I can sell it sooner when it goes back up, you know, and it's an opportunity. I look at prices going up as equally as an opportunity. My prices go up, I take profits.
Mm.
So I'm not, I'm not concerned. I think the market's down right now. I'm not. I haven't even looked yet, but I looked and I saw some red in the figures when I looked at Yahoo Finance. But that doesn't bother me because I know that means the orders that I put in to buy, they've probably gone off at a price lower than what I would have been happy with.
Mm.
And the ones I put in to sell, probably not so much. Most of them probably haven't gone off, but I can look at them later and adjust that. But it doesn't scare me. The COVID crisis, my feeling about that 2-month crash that we had was, oh man, why didn't it last longer? Because I get so much in dividends every month
Mm.
that I could have put back, literally $100,000 back into my portfolio at much, much lower prices if it had lasted longer. So it's a different approach. It's a different mindset at looking at investments when you focus on income than when you focus on growth.
Okay, so if you're doing this yourself and you don't have a manager, portfolio manager that's doing this for you or that you're working with, how much time during your day would you suggest somebody to devote towards managing and watching the numbers and the figures?
Well, once they get up to speed, it can be as much as in 2 hours a day. It can be as little as 2 hours a week,
Hmm.
depending on how long you want to say. And I've placed orders from the last couple of years. I've been placing orders when I'm traveling on my iPhone.
Mm.
With the app, you can see the same stuff. You can buy and sell. So it's something you pretty much can do at your leisure. If you just look occasionally and you put them in order, you'll see when you have to get in there to take those profits, because you don't want profits to disappear, because we've all seen them disappear. I mean, you've probably seen at least 2 major crashes in the market.
Mm-hmm. Mm-hmm.
I don't know if you were there for the dot-com bubble or not, but you experienced the financial crisis, you experienced COVID, you may have heard about the dot-com bubble.
Mm-hmm.
You might have still been in school or something like that. And going back to 87, the crash, all of those situations, this type of approach really got you through, because you always were taking your profits, and you always had cash around or income around to take advantage of the lower prices. And it's almost, it's the same thing. You can apply that to almost any type of a business. It gets to the point where your portfolio is a department store. It owns a lot of stuff. There's a lot of stuff in inventory. You're waiting for shoppers to come in and make you an offer. And when you set a markup, they tell you they want to buy something. You say, okay, here it is. And then you go out and put more inventory on your shelf. And eventually you get to the point where that's how you see your portfolio. There's no love. There's no real love for any one security, and you don't have a core portfolio. Oh, these are all great companies. I want them. You don't have anything like that.
Mm.
This is merchandise, man. Somebody wants to buy it. I'm selling it. I'll buy it back again and sell it again.
Sure.
Yeah.
Now, has AI changed the market or the landscape of how people invest?
I think it has for a lot of people. I think it has. I'm still convinced that the AI between your ears is enough in the investment world. I have people talking to me. I have one guy talking to me right now about he wants to develop an app that implements my process. And we're talking about it, and there's so many ifs, ands, and buts. On a macro sense, yeah, I can see where it could be done. You don't you buy certain levels depending on where the market is or where interest rates are. You could do that. You could set set a sell target and have that done automatically. I don't know how easy it would be to do it inside positions for various tax lots, but you could do it. You could do most of what I do. Um, but the having the machine take over, you're going to have to wait to slow it down sometimes, because in major rallies, you don't want to sell, you know, 25, 100 positions in a day and then figure out what to buy back into and stuff like that, or let that machine do that. I mean, things can get out of control. You just need to have some checks and balances that the human can take care of. But yeah, I think it's possible to do what I do automatically. My wife said that to me maybe 25 years ago. When apps first, well, probably wasn't maybe even that long, but when apps started to be developed, and she was into that stuff because of our children. To communicate with your children, you had to start to get involved and all that stuff. And she said, you could do this with an app. And I said, no way you could do that. Not a chance. I mean, this is not that easy, Sandy. But now when I'm looking at just my portfolio and not 300 portfolios, I'm just looking at my three. I say, oh, yeah. An app could probably say, yeah, we can go on this vacation now. You don't have to even look.
Hmm.
An app could probably do that.
Okay, so Steve, you've coined the term income independence. What does this concept entail, and why is it so crucial for retirees?
Well, when you get to the point of income independence, it means that you know that your income from your investment portfolio is not going to be impacted negatively by any type of a market crash, at least none that we've experienced so far.
Mm.
I mean, if you lived in your crane and you had this type of an attitude, it might not be applicable right now. You see what I mean? But in the United States, we've been a pretty safe uh, place to operate. So in this type of environment, your income is not going to be affected by any economic conditions or market crashes and things like that. Even in the financial crisis 2008, which was pretty much centered in the banking and finance areas, there weren't that many major Merrill Lynch, Lehman Brothers went under. But if your portfolio is diversified properly, it wasn't a big deal. And when you invest using closed-end funds whose equity portfolios contain an average of over 200 individual positions, none of them even close really to 5% of the portfolio. You can see like it's a pinprick. It doesn't really impact what's going on. So when those things happen and you know that your income is going to be unaffected, that's in income independence. It's different than financial independence where you say, yeah, I can sell that. I can sell that condo, or I can sell that property, or I can sell these diamonds and get the money I need. This is when your income is providing for all your needs. Doesn't matter what happens. In fact, as I was implying before, when I look at down markets as opportunities, if you have a down market or you have higher interest rates, you can put that back income back into use to produce even more income. If you can not spend at least 30% of the income you're producing, you can grow your income every year. If you find the time to take profits, you can grow your income every year. So, true, there are fewer profits when the market goes down.
But
So
there's
that's why you do all
profits
your
to go around.
analysis. All your analysis is based on your base income, the income that's coming in from distributions. So, yeah, that's income independence. That's
And
where I've been for a while. Yeah.
And I guess that circles back to that 10% where you want to always stay at or above that 10%, so that if you, like you said, if the 5%, if you take that 5% hit, it's not that big of a deal because you're looking for the
Right.
10% margin.
Right.
Yeah.
And that's the 10% margin was what I was doing in individual stock.
Mm.
When you start dealing with portfolios of securities, you have to lessen that a little bit because there's so many players, you know.
Mm.
So I use a 5% target now with the closed-end fund.
Okay.
And sometimes you'll go lower because, for example, when the market does go down, you don't have as many profits, but you do have more investment opportunities. So you can take a 1% profit, but let's say that 1% profit uh, brings with it $9,000 of capital that you can then add to other positions that are down.
Mm.
And that increases your yield, increases your opportunities for profits in the future. See, it all, there's always action to be taken. There's always tasks that you can do when you're managing a portfolio.
Right, because of course it seems that many investors, they try to prioritize market value growth, and your approach emphasizes income generation over market appreciation. Right? Am I getting that right? Okay.
Yeah, but in a rising market, your market values are also going to go up. And you're going to hit all-time market value highs as well. They may not be as high as if you happened to have a portfolio of individual stocks at that time, but it certainly would be as high as it's ever been. But your capital is growing all the time. As long as you don't spend more than you make, that base investment capital, it's like the Monopoly board. You keep putting your money back, you buy another house, another house, another house, then you have a few hotels and so on. That base doesn't change just because the prices change. That base is still producing those rental incomes. Mm. And that's the same way the stocks are, or the closed-end funds are.
All right, so let's shift gears a little bit to your book, Retirement Money Secrets. What motivated you to write this and share this information?
Old age. When I started writing it, I was 78. And you say, okay, and this was just before a year or so before I got the offer to sell. And you're saying, I'm doing all this stuff. I've got all this. I got this approach to investing that really worked well for people. It's done well. I've written one book before this called The Brainwashing of the American Investor, which was, people who read it seemed to like it, but it didn't get anywhere. My publisher went out of business, blah, blah, blah. So, but I said, and mostly some guys in this Facebook group that I had were saying that I ought to put all this stuff down. We ought to write a book. And we wrote a book together, basically. The group got together and we outlined what we were going to do. We developed we developed a lot of the illustrations together. And I got a ghostwriter and we had a conversation, and we made that conversation into this book, the Retirement Money Secret. And it told the story. It told what I was talking to them about in the group, of how they had to focus on income, how it begins with the quality of what you own. All investing, you got to have quality. You don't need to take unnecessary risks. You have to have diversification. You've got to focus on income production, and you got to take profits. Those are the four basic risk minimizers. I want to get that information out there. There's two other things that I put and emphasize in the book that most books probably don't even mention. The first of those, of course, is the emphasis on income. But the others are that we're in that there's a market cycle out there and an interest rate cycle. So we have a cyclical environment, and you can't expect your securities to just go up in price. You have to expect them also to go down in price, and you have to anticipate. You can't predict it, but you can anticipate it and take advantage of it. For example, stock market S&P hit its third all-time high of the year. None of the other averages have yesterday. So the market pretty much is at or near an all-time high ever. So you don't go out and spend. You don't go out and buy individual stocks at their highest level ever. You don't buy a portfolio of stocks. You don't buy as many of them as you would. So if your normal entry point on a fund containing 250 stocks is $6,000, you don't at this level you don't go for $6,000. You go for 4,500. You put in there because more than likely the price is going to go down. When it does, then you can get yourself up to that 6,000 level. And from there, if it keeps going down, you can get yourself up higher and higher and higher because your normal starting point should only be about a third of what your maximum exposure is going to be. So you can do that now. If the market crashes, then you say, I'm going back to my 6,000 each because now our prices are down, which is where we are in the income side of the portfolio. There's really only two classes of investment. It's either purchased for income or it's purchased for growth. Okay, two classes of investing. And same like that, the income portfolio, the income asset class right now is not anywhere near where it was 3 years ago and 5 years ago when interest rates were so low. So those things, you go for it. You don't have to worry about it going down much more. The only thing that's going to make it go down right now is higher interest rates. I don't think the present administration is even thinking that's a possibility, even though they're possibly creating the atmosphere where that would be the appropriate response. I don't. So who knows? You never really know.
Yes. So, Steve, in Retirement Money Secrets, you discuss kind of some limitations on the traditional 4% withdrawal rule. Can you explain why this rule may not be effective and what alternatives you would recommend?
It's in some ways it's very effective, but when it's the ultimate plan basically is for you to have nothing left when you die, basically, because 4%. If you take 4% every year, theoretically, that's 25 years. It's gone, and there's no income being produced inside. It's all being reinvested, and you're paying fees in addition. And each time you make a payment, you pretty much have to sell something. You have to reduce the number of houses you have on the board because you have to sell one to provide the money that you're going to spend. So it's not that the 4% rule is a bad one. It's just the way the community is now providing that 4% by selling the losers, so to speak. We're going to keep you in the stock market because that's where the growth is coming from. And when you have to need money, we're just going to sell the ones that haven't gone up yet. They never even think about, they've got at least 7 different varieties of securities out there that safely pay more than 4%. Safely. And they don't use them. They don't use them because they're not sexy enough. They don't go up in market value. And since we got out of the commission-based industry, where every time a broker sold you something, he got a commission. And the only thing they had to worry about was how honest the brokers were. And 99% of them were honest. And then, of course, the bad ones, the churners, the people like that, they gave it a bad name. And the SEC determined that it would be much fairer to the individual investors to have a fee-based system. But that's not working. In my opinion, that's not working out so well either, because it's, I used to get paid on market value. of the accounts that I was managing. So when we had a crash, and I wrote to my clients and say, not to worry, the income's still coming in. It's good news because we can take advantage of this. And I said, it's even better news because you don't have to pay me as much to do the same job because I get paid on market value, you know? So it's a changed world. And my feeling is that the same community, the same advisory community could generate adequate income for their clients and still make enough money.
Hmm. Now, you talked about something that was interesting. I want to kind of circle back to the market cycle. So with understanding that there's a cycle to the market, that means that you can you said you can't really predict, but you can start to see some trends. Okay, there's a high, there's a low, and you understand that it's going to come back around. And so you want to try to prioritize the low is when you buy things. That's when you're intaking the inventory to put into your store, and then you're selling at the high. That's where you want to exfil those. How can you apply that? So if I want to sell when it's high, but nobody wants to buy when it's high, how can I sell when it's high if nobody wants to buy when it's high?
The only way it gets high in the market is if there's more demand for it than there is supply. Okay, stock prices and closed-end fund prices depend on supply and demand. Okay, the only thing that can make the price go up is people wanting to buy it. So when prices are up, you use the market cycle. You can determine where you are, but you don't know where you're going.
Oh.
But yeah, you can see from the curve, I'm at the top on the stock market. I'm near the top. You don't know where it's going to go tomorrow. You don't know where it's going to go 5 minutes from now. But you know where you are. So like I said, if you're going to buy equities, if you're going to add to the equity side of your portfolio, you want to buy less than you normally would. But on the other hand, you're going to be saying, if it's this high, I ought to have some profit in my portfolio. And you're going to take those portfolios, and then let's say you have a 60% income and 40% equity asset allocation, like most older people have something in that range. 60% of the profit theoretically should go into income securities, right? Because that's the way your split is. So you take, so that's how you do it. So you're taking advantage of that area of the market value. You're going to be taking profits. You're going to be buying less of each stock you buy, because if it goes down, you want to be able to buy more of it. And if it goes up, continues to go up, you're going to take profit again. So that's how you manage the market cycle. And there's also an interest rate cycle. And the interest rate cycle and the stock market cycle, most often are going somewhat differently. For example, we have inflation. That doesn't hurt the stock market so much until, rates are cut. But in the meantime, the market's going up. And until they start cutting rates, you're not going to see the bond market go up. So, they're different. They're the same. You treat them the same. Okay.
So they're just two different parts of the same.
You're not timing the market. You're understanding the market cycle.
Okay. Yep. Okay.
When you're up, you're going to take your profits. You're going to buy less of new stock because it's likely that the prices are going to go down and they continue going up because they've never gone up forever, right? So you anticipate by buying less, goes down, you add to your position.
Okay. Well, okay. So I think that brings us into risk management pretty effectively here. So risk management, of course, is I think a vital part as it goes to investing and where to invest and how much to invest and all of this. And I understand you have the four great financial risks as it relates to risk management. Can you share those and kind of help us understand those?
Yeah. The risk minimization is really a key to investing, regardless of what type of securities you use. Um, the These four risk minimizers are coming up with a how do you determine the quality of something you want to invest in? How long has it been in business? Is it profitable? Does it pay me for the use of my money, since I'm either taking an ownership in it, interest in it, or I'm loaning its money by buying its bonds or something like that? How dependable is it at giving me something back? Um, so that's the quality. I never bought a new issue in my life because it's not making a profit. How can it pay me? How do we know it's not going to fail? So you want to have very strict rules about what is quality that it's acceptable to me. Like I never did any futures. I never did options. I never did IPOs. I never even bought mutual funds because of their structure. They're risky because of their structure. And I, but quality is number one. Diversification in your portfolio. After you have all these things in quality, you then want to make sure they're diversified. I mean, you don't want all your quality to be in one sector like energy or healthcare or blah, 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 whatever. You want to be spread as widely as you can. I take it much further than most people do. I Diversification is a risk minimizer, and most people think of it as a defensive weapon. You're defending yourself from excessive risk. I want to own everything in the form of these closed-end funds, so I make it into an offensive weapon, where not only is it protecting me from risk, but it's almost guaranteeing to me that if something good happens anywhere, I'm going to benefit from it somehow. So that's I do that. I go a little overboard in my diversification. Um, Income production is just what it is. I have If I'm buying an equity position, it's got to be paying me more than 5%. Today, the average on the equity closed-end funds is over 9%. And if it's an income purpose security or CEF, it's got to pay me more than 6%. Today's average is about 10%. Believe it or not, today's tax-free municipals in closed-end funds are paying an average of 6.5%, which is just unheard of historically. So that's the third one. And the fourth risk minimizer, because the risk of loss depends on how much profit you're going to lose when the market goes down, and it will go down. So if you own Microsoft and you've had it for 20 years, you've got pretty much 100% gain in there. Well, if the market crashes, that 100% gain could become a 20% gain real quick. So profit taking eliminates that risk. If you continually take your profits, you can reinvest in the same security over and over. Some people trim the profit and keep, they trim. If let's say they're up 50%, they'll sell 50% of their shares and buy something else. It's the same thing. It gets the job done, that type of thing. So profit taking is that's what most people are encouraged to do and forget to do and will not be encouraged to do. And it's not for any selfish reason so much. The key element, particularly in managed portfolios, advisors and the broker I used to work through used to tell me that when we were taking lots and lots of profits, like in 2021 and earlier, they're telling us we're selling too often, we're selling too much, and I said, but we're making tons of money for people. Doesn't matter. It doesn't look good. It doesn't, and this is what compliance officer telling them. And the main reason is that if you sell somebody's profit, you take their profit. Even let's use Microsoft again because it's so easy. It goes up 100%. You made the guy 100%. Hey, John, you got to take the profit in this thing. You've made 100% on your money. Let's spread it around. It does. pay income. Let's put some of it in corporate bonds, and we'll find another stock, and maybe we'll buy Microsoft again sometime. Okay, fine. It sounds like a good plan. So 5 years later, what's happened? 6 years later, Microsoft's gone up another 100%. And this guy over here is sitting on these corporate bonds, and they're sitting there just pushing out income, but they're not going up in price or anything like that. That guy, he really screwed me over by making me sell that Microsoft, and sues them and wins. Because brokers and advisors are supposed to be able to know what's going to happen next. And of course we don't. So it's advisors are very reluctant to suggest that you take profits because they know that this is possible. When I was managing, we designed a management agreement between myself and the clients. And it said 3 or 4 different times in that agreement, and if we have a profit of over 10% in any individual security, we will be taking that profit. We will take profit at any level up to that 10% as well. And they have to sign off on that. We got to protect ourselves from that.
Yeah.
Because in reality, if you take your profits sooner and reinvest it, you're going to make more money than if you held on to the same security, even with one of those guys, if you're lucky enough to pick another one like that. But those are the 4 things. You got to take your profits. You got to get income. You got to diversify. You don't have to be as insane as I am, but you got to diversify significantly. And you have to only select quality securities. Every time you go out of the range, every time you buy a new issue, every time you speculate on a new entity like Bitcoin or even AI on the individual stock level, not every AI company is going to become a NVIDIA. I just read about one yesterday, actually just went out of business, right? It may have been today where it's down 47% right now because it went bankrupt.
Oh.
I mean, that's what happens with new issues. So that you got to stick to those 4 basic risk measures. Understand that you're in a cyclical environment, ups and downs. Prepare, take advantage, and that's. And focus on that income instead of that market value, and you'll be fine.
All right. So we're going to shift gears here a little bit. I want to talk about close-end funds, or CFCs, and why they play such a significant role in your investment strategy, and not just for the investment strategy, but really for income-focused investors. And how? Okay, so let me backtrack a little bit. Tell me a little bit about CFCs and why they're so important. We'll start there.
Yeah, CEFs.
CEFs, yes, sorry.
CEF, closed-end funds. Okay, these are the oldest type of fund out there. They were developed in the early 1800s, before mutual funds were even thought about. And they're actually pass-through trusts. So like the trusts your parents may have created for you to pass the money through from the estate and things like that, where the estate doesn't pay any taxes, but you do because you're getting the income. That's what a pass-through trust is. So think of these entities. Think of Amazon if it gave 95% of its income to its shareholders from the first time it made a profit. It would not be the Amazon we have today because it wouldn't have been able to grow like that. So closed-end funds are designed to produce income for their shareholders, not market value growth. I own 250 closed-end funds. I don't think there's not one of them that's over $50 a share. There may be 5 that are over $40 a share in the whole lot. The average prices are, 15, 11, something like that. So that's one difference. They're not designed for growth. They're designed to produce income. Makes them totally different than any other entity. Second difference is from other funds is that their price is determined in the same way the prices are for other stocks. Because you own stock in this trust. You don't own the securities inside.
Mm.
You own stock in the trust. And their prices are determined by supply and demand, just like the stock market. Okay. That differentiates them from mutual funds because mutual funds prices are manipulated every night. They either add shares or take shares away, you know, to make the price and the net asset value equal. So if the market value is going way, way up, the net asset value is going up. The number of shares times the price has to equal that net asset value. It's going down the same way. But the thing, and they're supposedly managed, but are they? Because when you have a crisis and everybody's selling their mutual funds, the managers have to sell the stocks to give you the money. They have to sell things. Whereas a closed-end fund manager, you're trading that stock with somebody else, another person. It has nothing to do with his management. So he can be there, sit, oh, wow, the prices are going down. I can buy more. I can make more money from this. They can do what I do. You know what I mean? And with ETFs, the reason they became popular was because their fees were so low because they're not managed at all. So they're not managed at all. So you're not getting the same type of skills, and their prices are all also tied directly to the net asset value, unlike stocks and closed-end funds. The CEFs are quite different. They have literally they pay monthly dividends even when they hold securities that pay semi-annual interest. They still pay monthly distributions. A few of them pay quarterly, but they're mostly monthly. You can get any stock you can even think of will be in some of the different sector equity funds. The income funds own everything from real estate to corporate debt to municipal bonds, any type of debt securities you can think about. So you can totally be invested in everything by using them, and they're focused on income, which makes them perfect for people thinking about developing income, people who have big jobs and are generating a lot of money, and their exit plan requires them to be making as much money when they're done for that, and for retirees. So they're just a perfect vehicle for what I do. When I was managing and what I'm doing now for myself and for coaching clients.
So
So they're quite a different thing.
Do you have any insight or pro tips on how to select a suitable CEF to add to your portfolio?
Yeah, you gotta get in touch with me and I'll sell you the universe. No, seriously, I do have a community now where people can join the community and they can get all the selection universes that I prepare, and there's 4 of them. I have a separate listing for tax-free municipals, other taxable income, stock market, and I have one for ETFs.
Hmm.
And I only have about 20 ETFs in the list. But the people in the community get them as part of the membership. But there's also a place called Closed End Fund Connect, CEF Connect, which is a website run by Nuveen, and you can look up all the CEFs there are. You can look at the yields. You can look at what's in them. You can figure out all different characteristics about them. But you really should learn about them from that book we talked about, Retirement Money Secrets, because it tells you all about them and how they operate.
Okay, so Steve, I had a question with 2 parts to it. Let's say you had somebody that was young and was looking to get started into investment.
Yeah.
What steps would you give them to kind of set them on the right path? And then, so that's the first part. And then the second question is, you have somebody who is already retired and they want to enhance their portfolio to increase their income generation.
Okay.
what steps would you give them? So two parts. So first one is brand new, knows little to nothing, and the second one is already retired and looking to increase income.
Okay. Well, the young people, if they're even if they're just out of college and are not a finance or major, probably don't know enough about investing. We just talked about the two types of corporate securities: the ownership or stock, and the debt or bond type things. Most people come out, and even after they started working and they've got a 401k, they probably don't know the difference between a stock and a bond. They probably don't know what they're investing in their 401ks. So the first step for them is to get an education before you go throwing your money at something that you don't understand.
Hmm.
And I can't emphasize it any stronger than that. They've got to read a book. I think my book is a big help. I think um, they can get books that explain the corporate structure, that really go into details of corporate finance and cash flow. And when they do that, they'll see that cash flow is what makes any business successful. There are many, many companies that had good products that didn't sell quickly enough or catch on quickly enough that they never actually capitalized on. They went out of business, but somebody bought them and refined it and put it and managed it properly to produce cash flow. Uh, Cash flow is the very essence of my approach. That's what income is, part of cash flow. So learning about that process, that whole financial, the capitalism, what is really capitalism, is really an interesting thing. I mean, I'm not going to say that all capitalists are good for us, but capitalism is
Hmm.
good for us. Okay, so that's for the young person. The young person has to understand first, and then he's got to realize that there are two times in your life where you don't want to take unnecessary risk. The first time is when you're young. You don't want to speculate and lose because you'll never build up an income machine. You want to go safe, safe, safe. Now, I would say until you get to six figures, you should focus on that. Might be a little high, maybe 50, but somewhere in that range before you even think of going into the stock market. And when you start to go into the stock market, don't call a broker and say, "Hey, what's hot? What's going to be the next big winner?" You don't do that. I think closed-end funds are perfect for starters because you can buy every stock that it's out there in a package that's $15 a share. I mean, why knock yourself out and pretend that you can pick or anybody else can pick the next big winner? You can't. So be safe. Go safe then. When you're comfortable, when you got the big job and you got the big money in the bank pot and you've got a nice 401k going and you want to go out and say, I know Bitcoin is a speculation, but I'm going to take a chance with X amount of dollars. No more than that. You know, then you can speculate a little bit because you know you got this cash flow coming in and so on. Retirees, retirees, some of them are in the same dilemma. And actually, my ghostwriter, who was getting on to that age, was saying to me that most people, the only investing they know about is the 401k. And they're not real sure what that is, but they've never done any of this themselves. So they too need some education. So if you're a retiree, same thing. And you want to do it yourself or you want to work with somebody, um, learn about it, learn a little bit about economics, learn about cash flow, learn about how important that is, particularly to you. Um, Take a look at somebody you know who's traveling all over and doing all this stuff. He's doing that with income or he's selling his assets. Unless you got an awful lot of assets, it's not going to work, you know? So everybody needs an education. But then again, you want to minimize risk when you're retired. So look in your portfolio and most people They'll still have stock left over from the company they worked for, and it'll be a big proportion of their portfolio, and it's not paying any dividends. No matter how much you love that company, this is your way of saying thank you. You sell the stock and you get the money and you invest it for income so you can live your life and you can still thank them for getting you the wherewithal to do it. So that's a lot of things. Retirees will have very, very poorly diversified portfolios. They'll have situations like that. They'll have fallen for the core investment strategies and stuff like that. And they don't have enough income being generated. And that's what they have to transition to. And that's pretty much my specialty is helping people transition from a growth focused portfolio to an income focused portfolio. And you'd be surprised how quickly they pick up on it. And I'm amazed in this community that we're developing how many different approaches to running their portfolios and finding profit taking opportunities and determining which closed end fund to buy and relating it to we have this risk pyramid in there that shows the relative risk of different strategies. You've got a low risk total concept in a closed end fund, but equities are more risky than income and so on. So there's this eight tiered pyramid, and they've come up with very creative ways to determine how they are related to that risk pyramid. So these are people who are starting to do it themselves, and some of them have large sums of money that they're putting to work, and they're really studying it, and they're much more tech oriented than I am. And I don't know. I don't spend that much time on statistics and numbers and things like that. I'm more of a trader approach, and some of these people are more technical, but all the approaches work, and the income's still the same, or the income's still coming. So that's where they have to get to, where they're getting. Let's say they still love their stock market. Well, they can put 30% of their portfolio in equities, and they're paying them 9%. Instead of look at how pretty it is and it's paying 0%. I mean, Nvidia doesn't pay a dividend. Amazon doesn't pay a dividend. Microsoft pays maybe this much. So that's the key element. So young or old, education. Very young, risk reduction. Then you go to the stage where it's okay to start getting into the stock market because you're going to understand it better and all that. Then at the lesser age, you're removing yourself from the higher risk elements and getting back into the income.
Well, Steve, I want to say thank you. Thank you for sharing your wealth of knowledge and experience with me here today. Your insights to income-focused investing, achieving income independence are invaluable to anybody, young or old, looking to invest in their future. And before we wrap up, do you have any key thoughts or final takeaways you'd like to share with the listeners? And if they wanted to get in contact with you, what would be the best way for them to do that?
The best way would be to buy the book and read it and come up with a long list of questions. That would be the ideal way. And then I have a website called theincomecoach.net. And we have it's called a platform. It's called School, SKOOL. And the name of the community is the RMS Income Investing Community. And that's another place they can get to me. And it has all the features of a Facebook book. It has private chats between the members. It has different tabs where we put articles and opportunities to meet other people that do things, different types of professions. All the podcasts go on in this community. So your podcast is going to be in there eventually, So it's got a wealth of it. We do Q&As. We're going to do 4 different topical Q&As in February. We're going to do another 4 in March. We'll have 10 educational Q&As up there by then, and our plan is to have probably another 10 or 15 before we're done. And I'm sure from the type of questions that come up within the group that they're going to want more Q&As on different subjects as well. So it's very dynamic startup type environment right now. So that's another way they can get an education too, because it's there.
Wonderful. Well, and listeners, if you want to learn more, check out Steve's book, Retirement Money Secrets, and be sure to visit the incomecoach.net and check out his school. School is that the app? Is it an app, right? Website?
It's a platform. I guess it's like Facebook,
Oh,
but
okay.
it's only for people who want to develop these types of communities.
Okay.
Yeah,
The
it's
school
interesting.
community.
Yeah.
Okay. And listeners, remember, making informed decisions today can lead for more
Prestigious.
a more prestigious tomorrow. There we go. Until next time, this is Chris Bean reminding you to make every day count.